Welcome back to Count Me In, the podcast for accounting and finance professionals working in business. I'm Adam Larson, and today we're going to talk about something that is no doubt near and dear to you, namely your money. My guest is Kyrill Asatur, the CEO and co-founder of Centerfin. As a longtime advisor to hedge funds and other large institutional investors, Kyrill was often asked by friends and relatives for advice on how they could better manage their money. You know, how the big shots on Wall Street do it. And for a long time, he didn't have a good answer for them because that institutional level of service and expertise simply did not exist for individual investors. This is the story of how he decided to correct that inefficiency in the investment management ecosystem through the power of Fintech. This podcast is a must listen for anyone with a 401k, an IRA, or any other investment accounts, which means it's pretty much for everyone. So let's get started. So Kyrill, thank you so much for coming on the podcast. I'm really excited to have you on. And I figured we could start off by just kind of introducing you to our audience and just so you can give us a little bit of background in your story.
Sure. Thanks for having me on, Adam. So my background is about 20 years ago, a little over 20 years ago now. Out of undergrad, I joined at the time it was called the Global Operations Division at Goldman Sachs. And it was an analyst program, a 3-year program where I got to rotate through several different roles. And so I did that. I was in foreign exchange for a little bit, then equities, and then decided to find an area of the firm that aligned itself with the hedge fund industry. So I got personally very interested in the hedge fund industry, just kind of always been reading about hedge fund managers. And at Goldman Sachs, there's many different ways that you can imagine you can interact with hedge funds, but the one business that was directly kind of correlated, so to speak, with the hedge fund industry was the prime brokerage business, which is basically serving kind of all hedge fund needs. And Goldman had and still does have the kind of premier prime brokerage business, top 3 prime brokerage business in the country. And so I was able to get myself a role in that business. So I was there for another 6 years, 5-6 years after that, after my first 3-year rotation. And then I joined a hedge fund that I covered. They're actually ex-Goldman guys too. And I was with them for another 5 years. Ultimately got recruited into a couple of different roles with other firms, and decided in 2016, so now about 6 years ago, to start my own advisory practice, and initially focused on working with hedge funds and other alternative investment managers, very organically and really through, as they say, necessity is the mother of all invention. I decided to start what is now Centerfin. And the idea was really because over the 2 decades or so that I've been working on Wall Street, I've always struggled to help friends and family that come to me and ask me about what to do with their money. So they might have a retirement account or a 401k or just savings that they've saved up that they would like to invest. And frankly, I just never saw any great options out there that I can point them to. And having spent my whole career, or at least the biggest part of my career, interacting with large, sophisticated institutional investors like pension funds, endowments, foundations, family offices, I basically learned the way that they invest their money, and it was very different than the options that were available for if you're kind of an average Joe or Jane, so to speak. And so Centerfin was founded to address that need in my mind, and we're basically 2 years into it, a little over 2 years into it. We went live at the beginning of this year. We have a tech-enabled, kind of tech-forward service, and so we spent a bunch of time building it. But we went live at the beginning of this year, and growing nicely in these crazy markets.
Yeah, the markets are very crazy with everything that's happening, the inflation, and in the past 3 years with the market, the way it's going, I know it's been really crazy for everybody. And I know organizations, and I think our focus will probably be more on organizations and people within those organizations. I know organizations are looking to invest in trying to build their wealth as well as they're trying to keep above water in this industry. What do you think the future of finance is looking like as things are continuously changing and the finance team has to adapt as they go along?
Yeah, absolutely. So really technology is playing a bigger role in everything, right? So One of the reasons why, we started our company and the way we structured it was because we felt like technology was something that could be used to just, create more efficiency in really any process. But for us, it's, the investment process, managing people's money. And by create efficiency, I just mean, do things in a way that are cheaper to the end consumer. So for us, it's an individual, but this works all the way up and down the chain, internally at an organization, or or externally, depending on, we all have clients we serve, right? And so I think technology is a major, and you've heard about it, right? People refer to it as fintech, right? It's finance and technology kind of combining. And I think the interesting thing is that I think it's still early, quite frankly, because I do think that technology is, making its headway in kind of in helping create efficiencies in organizations and in processes and procedures. But quite frankly, most of the financial kind of world infrastructure is kind of still what existed, 20, 30, 40, 50 years ago in some cases. And so there's just a lot of opportunity.
There is a lot of opportunity, and as you mentioned, that a lot of the systems that are in place are still the same things that were built years ago. Now, is it more advantageous to go with a solution that may be more digitally native, that doesn't have the original like backbone of the original structures, but is kind of trying to be more agile and adaptive with, as technology advances?
Yeah, I think it's absolutely advantageous. So, I actually was having a conversation with a former colleague this morning, and what struck me is that even when you try, and this is somewhat by design, but even when you try to structure your business in a way that's very customer driven, right? And that's really our ethos, is that, we really want to focus on the customer, what's the right thing for the customer, for the client, for the investor. And even if you try to do that, it's hard oftentimes in kind of when you have kind of legacy partnerships, right? And so our perspective was always, find the right partners that have the technology, and we spend a bunch of time obviously finding them, and then build our own technology that's completely new, right? So there's no, it's not building on top of something that is, maybe legacy 20 or 30 years ago, which is kind of what often happens in kind of bigger firms, bigger incumbent firms. But build something completely de novo, as they say. And by doing that, by focusing on, like I said, efficiency, cost, you're able to pass that through to the client.
That makes a lot of sense, and you're able to kind of, in a sense, be more agile, which is kind of what you're looking for in in especially in fintech. You need it to be agile because you have to adapt as you're going along, right?
100%. Yeah, 100%. You have to. I mean, any kind of new firm, you have to be, agile, but in fintech, it's very important.
So, can we talk a little bit about how this type of software, these type of solutions will affect the accounting and finance team as they're trying to adapt within their organization?
Yeah, so I think that accounting and finance folks, it kind of, it kind of depends on at what angle you're looking at it through. I think just on a personal level, right? So every professional, or not professional, but accounting and finance professionals have their own retirement savings accounts. They have their own taxable savings accounts that they've been able to accumulate. Using technology, using software to help things will just make those solutions better. Just solutions that are available to them better. And I think within their roles, I think the use of technology, kind of more broadly speaking, should also make their jobs less kind of labor oriented, so to speak, right? So, you can use technology, and actually now reflecting on this, and my early days at Goldman Sachs, I was in operations, and what that meant was just kind of, everything that wasn't, is referred to as the back office, right? So it was everything that wasn't the front office. So once a trade gets done, it kind of comes down to us, and we handle it. And we were very encouraged to develop, processes and procedures to make what was at that point referred to straight through processing, right? So that there's very little kind of manual intervention. And I think, fast forward 2 decades, I think that trend, again, I think for a long time, lots of things were being kind of cobbled together, but technology just makes that trend so much more powerful today. And that's gonna have a ability for folks in those seats to do higher value type work, right? So to do less stuff that's a little bit more manual and labor intensive and focus on things that are, potentially higher value.
Yeah, definitely. And I was reading some, some stats. There's, hundreds of billions of dollars going through fintech every year. Do you think that that's going to continue to grow as more and more people move that direction, especially as especially as the technology grows?
I think so. I mean, obviously, we're going through a period of time right now where, we kind of went through a period of time, not to take a too much of a step back, but we went through a period of time where money was abundant, to put it pretty simply, right? We had, in response to COVID, the Federal Reserve and other global central banks, printed a lot of money. You've seen this in the press over the years. It was there. It was done to kind of stabilize the economy. It was done to stabilize markets so that we wouldn't go into some version of a depression. And that money eventually finds its way into speculative ventures like, startup fintech companies. And usually what happens is that, the more speculative, the more you'll see kind of capital flow into that stuff. So you saw it in crypto and NFTs and advertisements. I'm sure you've seen advertisements for investing in art as as an investment, or wine, or things of that nature. That's very typical of kind of late stage behavior in a market cycle. And we just went through that, and now the air is kind of coming out, so to speak. But that being said, as it relates to fintech specifically, I do think, while it's probably healthy to have some decline in growth in the capital that flows into the industry, I do think it will continue to be an important area of focus, simply because I think it is really hard, not impossible, but it's really hard internally at, like, at least in some of the big banks that's kind of where I grew up, to innovate that much. You can make adjustments on the margin, but if you want to take a just very different approach, it's hard to do so. And so that, for that reason, I think that money will continue to flow into fintech.
Yeah. So, thinking about individual employees within organizations, what role do you think that employers should play in helping with their employees' personal health, financial health? Because, you want to keep your top talent, you have to connect with a good fintech company to make sure your investments are good, to make sure all that stuff's flowing. What role do you think that they can play in that?
Yeah, it's a great question. We actually think they should be playing a bigger role. So most larger companies offer retirement services, right? So they'll have a 401k plan, and they'll do a matching grant to, up to a certain percentage of what you put in, or if your salary and whatnot. And it basically stops there. I think, I mean, at least I've seen some of this recently. I think some larger companies and corporations are embracing kind of a more holistic approach, right? So offering their employees, whether it be, managing their student debt or their credit card debt, or thinking about, not just their retirement assets, but if thinking about, how to, plan to save, for a home, or to make other investments outside of the retirement world. So I think that should be something that big companies and corporations are offering their employees. And it's not very typical right now, as you probably imagine.
So what about the small to medium sized business, who doesn't have the big resources that the big corporations, that the examples you just gave? What options do they have for helping regain top talent when there's a small trying to get themselves, or they're just not a large business, but they're trying to get good people?
I think they're a great candidate to work with fintech firms, relatively younger firms like ourselves. I actually, in a very early deck for Centerfin, I put something at the end that said something like, eventually, we will hope to be a perk a company can talk about to, prospective employees or existing employees. And the reason I say that is because, what we do is very technology enabled. Again, we can do it fairly quickly, and we can do it at a cost that is, a fraction of, a traditional provider. And it's solely because when we were founded, how we were founded, what our goals were. And so, and we're not the only one. I mean, there's folks out there that are talking to, it's becoming, more common, but it's still very, very early.
Yeah. No, that's great. It's great that they have an option, because sometimes these great options are available, but the small to medium-sized businesses are overlooked because they may not have the immediate capital to invest in something like that.
Yeah, absolutely. And I think it is a big, again, if you're taking on a, something like a 401k, it's not an easy thing to set up. We don't necessarily we do manage retirement money. We don't necessarily manage 401k accounts. Doesn't mean we can't, but I bet if that's something that, somebody, a smaller business wanted for us to do, we can probably get it done fairly cheaply.
So when thinking about just personal finances, everybody has their own struggles. There's obviously issues in the United States. There's issues all over the world with different personal financial problems. Do you think that the emerging fintech technology can help solve some of those problems that people are running into, especially with thinking about different types of investments and building that wealth that everybody kind of desires?
Yeah, 100%. So it's why we started what we started, when we started it, because especially today, the investment approach of the last couple of decades. Let's just take that time frame, because that's the time frame I've been working in, where most of my contemporaries have been, as they develop wealth, have been managing their money. There was a fairly kind of, not easy, but a choice of using a very low cost index fund, right? Obviously pioneered 40 years ago by Vanguard. It became a very easily to kind of implement and accept strategy for lots of individuals for their personal finance, and it makes all the sense in the world, except it made sense in the market environment that we were living in, kind of post financial crisis up until COVID. And the reason I say that is that, you mentioned, problems, and problems not just here, but globally. Well, there are a lot of problems. And I mean, there's always a lot of problems, but, the world is always changing. But the difference between now and, the prior, call it 12, 13, 14 years, is that we are seeing things that we haven't seen in 40 or 50 years. So, and by that I mean things like inflation. I think before we started recording, we touched on it briefly, but inflation is not something, at least in the U.S., that we've seen since the 1970s, right? So nobody of our age or younger has any direct knowledge or experience with inflation and how markets work with inflation, and even the professionals, obviously, that are managing money don't have experience with inflation. But one of the things that we do is, given our backgrounds in the hedge fund industry, we're still pretty plugged in to that world, and there are a whole slew of hedge funds whose kind of role it is to manage money on a kind of global macro basis, right? So all they do is try to interpret these things where, is inflation a problem? And if inflation is a problem, what do you do? And what does that mean for, traditional investing? And so I think in today's environment, and it's very recent, and potentially has staying power, you really need to be cognizant of inflation and the effect it has on traditional investing strategies. And so that's one of the things we talk to our clients about, we write about, is that the low cost ETF approach made all the sense in the world from, call it, 2009 until 2000. Even if you want to fast forward to 2021, at the end of last year, there are some real scenarios out there, not and smarter people than I have talked about this, but there were some real probabilistic scenarios out there that approach, just buying a kind of a very, very cheap Vanguard equity index fund, could yield no to negative results over some foreseeable future. So what's not often talked about is that approach from 2000 to 2010, a whole decade, yielded no return. You actually lost a little bit of money, and it's not widely talked about because it's not convenient to talk about it. But the truth is that if you tell somebody today, hey, listen, if you start investing and in 10 years you're not going to have any, you're not going to have any more money than you started with, you might have, on a real basis, less money because of inflation. They're probably not going to, they're probably going to be surprised by that. But that's really the world we're living in right now.
So basically, what I'm hearing you say is that if you're going to start investing, if you are investing, if you have investments right now, as we look at the inflation that's happening, start educating yourself, start having conversations with whatever company you're using to invest, because we need to talk about this. We need to learn from history, because the people who are, who are working at that time when the inflation was hitting, they're probably retired, or, they're doing all that stuff, or retiring now. And so we need to find that balance, because we need to get that education out there.
Yeah, 100%. That's what we would recommend is, talk to a professional, bring it up. All these big organizations have economists, and they all have, opinions on this, that, and the other. However, again, none of them, maybe very few, but none of the ones that I see on TV every day were actually alive or adults when the last time we had this kind of environment. And not that we were, but what we try to do is educate ourselves so we can help our clients navigate this environment better than just kind of what has been working in the recent past.
Now, do you think it's up to the employer who is providing this to their employee to provide that education, or do you think as individual people we should be researching that ourselves, or is it kind of like a dual?
I think it's in line with kind of what I said earlier about employers providing their employees with resources that are above and beyond kind of what historically was thought to be enough, right? Because more so today than in recent past, that advice is really, I think, valuable to individuals. And I'll give you another example. So cryptocurrency, very popular topic, has been around for, just over a decade, but really has gotten, mainstream attention probably over the last 5 or 6 years. And, I, like everybody else, heard of it when it first kind of became more popular, started to research it myself for myself, started to think about, if it makes sense, came to the conclusion that I think there's something there, but it's still early, it's risky. And so when I think about how much money to put in it, it has to be small, right? It's in my opinion, especially 5 years ago when I first got involved, it's not any different than gambling with potentially huge returns, but also potentially huge losses. And so any friends and family, and again, kind of going back to my motivation for starting Centerfin, any friends and family that would come to me over the years before we started Centerfin, and say, what do you think about Bitcoin? What do you think about Ethereum? There's like this, other token that I heard about. I tell them all the same thing. Like, I think Bitcoin and Ethereum are kind of interesting. I'd make a small allocation, call it 1 to 3% of your overall kind of assets that you invest, and see how it goes, and keep yourself educated, but don't over risk it, right? And then you hear in the press, like, as crypto went boom and bust, like a lot of other speculative assets in the last cycle, you hear stories that make me really sad, where it's not because people are stupid by any means, like, it's just they're just not educated on it. But you hear professionals in various different fields that put 90% of their savings into a token that then went to zero, and or put it in a platform that wasn't researched well and went bankrupt. And you hear these stories time and time again, and I think it affects hundreds of thousands, if not millions of people. And if that person's employer gave them a resource where they can go and ask that question and get professional advice, maybe they would have avoided that. But now they're potentially in a catastrophic situation for themselves and potentially their families.
Yeah, I can see how that could happen. So, as we kind of wrap up the conversation, I just wanted to kind of get your view. Wall Street looks one way right now. We have a number of exchanges. We've got stuff in Congress for possible other exchanges for smaller companies that could be going through. What's your view on Wall Street right now, and how do you think it'll look as we go into the future, as things are constantly changing?
Yeah, it's a great question. I think there's a movement, and to your point about exchanges for smaller companies, I think there's a movement to make the products that Wall Street generally peddles in more available, right? So that you hear, and I don't like this term, but you hear a lot about democratization of certain things, right? And I think it's meant to mean that, you're leveling the playing field, allowing a wider audience of companies and individuals to access certain, products and services, right? And so I think that trend has been going on for a long time. That will continue. I think, to speak of crypto, actually, I think there are a lot of folks in the crypto kind of blockchain space that think that the technology of blockchain will play a big role in, which is really just a technology, but it will play a big role in the rewiring of some of the kind of guts of Wall Street. And that could mean, really good things for the end consumers of their products. And I think, there's lots of folks in crypto who think that, crypto is kind of the parallel Wall Street, a parallel financial system. A little less inclined to believe that, although I do think there's some elements that make sense, but it's just very hard to get your arms around it, given, it's a highly regulated space, it's global, and it's just hard to kind of get there. But I do think that there will continue to be a trend, and it will be good for, everybody involved in kind of creating, more efficient, more widely available products and services on Wall Street. And so, so I think that's going to continue, and I think it's going to be good for everybody involved.
Yeah, and maybe even something that could help distribute the wealth a little bit more, as opposed to just a elite few who makes small moves and it moves the market a crazy way, as opposed to allowing for others to get involved as well.
Yeah, 100%. So I think that's part of it. I think the other part of it is, I'm a big, you've heard me talk about it now the whole time, but like I'm a big proponent of, like the way I kind of see the world. And I don't know if this is like too simplified, but the way I see the world is that, at least let's focus on the US. You have, the reason the US is so special is because we have this free market system, right? We have capitalism, right? We have, if you wanted to start a business, you can go and find capital and use that capital to build your business. The capital markets, right? The access to that capital is what Wall Street largely controls. And I do think Wall Street, as it looks like today, is just a very big, to your point about distributing the wealth, right? It's a very big drain of generally expenses that take their kind of, take a big bite out of those capital markets. But the basis of those capital markets is actually our money, right? So it's your retirement funds that are in a pension account. It's your, savings that you've put in the bank, right? Even the endowment, right? Like, wherever you went to school, let's say you contributed to the endowment to help out. That's your money that you've just given to your endowment, right? And so the basis of the capital that runs the capital markets is all of ours. And Wall Street is really just a machine that kind of, helps create efficiency in those capital markets. And I think that can be done in a much better way. And, we're addressing it in one little small niche, but I think that trend will continue as well. And that's a big part of fintech.
This has been Count Me In, IMA's podcast, providing you with the latest perspectives of thought leaders from the accounting and finance profession. If you like what you heard and you'd like to be counted in for more relevant accounting and finance education, visit IMA's website at www.imanet.org.